like, that's crazy. Private lending's way too risky.
My first deal was 10%.
Yeah.
The one after that was 10. And then came an 8% one. And right away I was like, I'm good.
If it took me a month, you're taking 12% risk, but you're making 11.
And if it takes 2 months,
then you're taking 12% risk and getting paid 10.
What again is the percentage of deals that get to enforcement or possession?
1-2%. Like it's so low. And there's a reason why banks lend 80% to people uninsured. Okay, welcome back to The Wealthy Lender. This is episode 15. I'm Chris Nichilo, licensed mortgage broker, financial literacy, and founder of Magnetic Capital Group, Canada's premier private mortgage firm. And today, we're pulling back the curtain on private mortgage yields and what those returns really mean. See, whether it's 6 or 11%, every percentage point tells a story about borrower quality, risk, security, and strategy. And in this episode, I'll walk you through how professional lenders evaluate deals across the yield spectrum so you can understand exactly what you're getting paid for and why. And I'm happy to be joined again by my friend Nick. Nick, I know you have thoughts on this topic. It's so, I'll say one thing and then I really want to get your thoughts, but it's always funny to me how often when I get out there and I'm like, listen, if you can find a first mortgage at under 65% loan to value and somebody will pay you 6.5 or 7%, you should take it all day long, put it in your fixed income side of your portfolio and enjoy, 50 to 75% better yields than anything else in the fixed income side of your portfolio, bonds, high interest savings accounts, GICs, all the rest of it. And it's always funny, people will post comments and they're like, that's crazy. Private lending's way too risky to get just a yield of 6.5 or 7%. But when you break it down, I think what people are missing is there is a spectrum of risk and there is a sweet spot in private lending against residential properties in that 6 to 11% range where you can essentially customize your portfolio however you want and sleep very well at night. Would you agree?
Totally. Well, new Nick agrees. I just want to roll the clock back a little bit with new private mortgage investor Nick.
Yeah.
And I remember my first deal was 10%.
Yeah.
The one after that was 10. And then came an 8% one. And right away I was like, I'm good. Just give me the next one, or I'll wait till, I'll hold out till 10. And because I was like, I didn't perceive it to be extremely risky because, there is some, you do kind of lay it out in terms of what we're getting into, with investor onboarding and all that kind of stuff.
Yeah.
But I was like, you know what, if I'm taking this minute risk, no matter how small it's going to be, and I'm playing this game, just give me 10 or 11 or, and after you broke it down and you explained why 8 would have been a more than enough yield and also a sound strategy, because there is the opportunity cost of waiting for the next deal. I was like, all right, this makes sense. There's no reason to not get 8, not get 7. At the time, I guess yields or rates were they lower? 2019. I don't think 6 was commonplace in 2019, right?
No, I mean, I wouldn't say 6 is commonplace today, to be honest.
Okay.
I mean, it's not
Okay.
commonplace. I think that's the other piece that people have to realize is that, we don't know what application is coming next, right? But we know that there's a fairly good distribution between 6 and 11% that, if you take what comes, right? So if you're very good at evaluating applications, if you're very good at harvesting applications, making sure you have enough to choose from, right, coming in, and then when you're evaluating, you're good at assessing them and from strongest to weak, and you live in that, you accept that you're living in that world of 6 to 11. Well, you're likely to end up 5 years later with a very balanced 8.5.
Right.
8.5, somewhere closer to 9. For us, it's been a little bit more. I think it's not a fully equal distribution. There are more 9s, 10s, and 11s than there are 6, 7s, and 8s. But by taking what's available, right, and not trying to control it, there's enough there that your yield in the average will be very good. 8.5, 9, 9.5, somewhere in that range, if you take what comes. But you'll also have the money invested for more days of every year.
Yeah. Yeah.
Right.
It's going to keep working.
Yeah, and this is a big issue. I mean, I don't want to share the math on it that in the simplest form is like, let's just say you're holding out for 12%. And the reason I 12 is because it's 1% a month. If it takes me, I think 12% deals oftentimes are much riskier than 11s or 10s, like exponentially riskier. And so a couple of mathematical alarms go off in my head. If I'm investing $100,000 and to go from 11 to 12, I earn $1,000 more a year. I think it's like $86 a month. But I'm taking exponentially more risk. When you put it in those terms, it's like, yeah, I'm good. I'm good, right?
Yeah.
But there, as you mentioned, there's opportunity cost for waiting for a 12. So if you're like, well, you know what, I'm good with the risk at 12, which a lot of people are, right? Lots. So it's not uncommon. Second mortgages under 80%, 80% at 12% interest or more, 12.99. You see it, you see all kinds. But if you said to me, Chris, I only want 12s, for me to find a qualified 12, if it took me a month, which is not a lot of time, then you're taking 12% risk, but you're making 11.
If it takes 2 months,
Then you're taking 12% risk and getting paid 10.
Yeah.
So listen, there are times where 11s come rolling through the door one after the other, and they're great quality and it's great, but you just don't know. You have to take what comes. You don't force it. And so what I do know is that there's no shortage of borrowers looking to access equity in their home that the bank won't allow them to touch.
Right.
So there's always a steady flow of opportunities, at least there is. And if every dollar you had just went into the next mortgage, I'm pretty confident 5-10 year outlook would be somewhere in that 8.5 to 9.5% range. But don't forget the power that the 6s and 7s and 8s bring to the portfolio in terms of security.
Okay, so let's go tier by tier then. So let's start with 6. So when I hear 6, the first thing that comes to mind is like perfect credit score, high earning professional, property, collateral's in a desirable area, and exit strategy is pretty sound. It's just that like some really fringe technicality prevented them from being approved by the bank. Would you say that's what 6s look like?
Not particularly, because there's no such thing as a private mortgage that doesn't have something
Yeah.
wrong with it. They're not entirely square. You're not wrong about the things that you listed, but the one thing I think that you didn't touch on is the loan to value. I mean, that is
Okay.
the biggest distinguishing characteristic between a 6, and let's talk first mortgages only to make it simpler. So 6, 7, 8, 9. Okay.
Yeah, there's no seconds that are 6, are they?
Firsts? Oh, seconds? No.
Okay.
For us, no. Seconds would start at like 9.
Okay. So you're saying the best descriptor is like low LTV in first position. That gets you. That's where
Yeah,
6s
so
live.
this is where we start, right? First position, you're in the best priority, lowest LTV. For us, 6.5 would be 65% loan to value or better.
Okay. So to the commenter, that's like I would never take on the amount of risk that comes with lending privately to get 6% yield. What would your response be to that?
I'd say it's short-sighted.
Okay.
Completely short-sighted. I mean, essentially that person is painting all private mortgages with the same brush and saying, well, they're all risky, right? And so 6% is crazy. Well, okay, but let's put it into different terms. I see you on the street. You've heard this example a million times. I come to you and I want to borrow $650, and I'm going to give you a piece of pure gold that's worth $1,000 to hold on to until I pay you back the 650 plus say 10%, $65. That's risky. All the risk gets shifted to the borrower. All the risk there. The borrower doesn't care. You said it before yourself.
I don't want him to come back.
At that point, yeah, you're hoping he doesn't come back. I mean, that's ethically, hopefully you're not actually.
I'm just no. I'm saying that to paint the picture. I'm not like
yeah, but that's what goes off in your brain, right? You go, if he doesn't come back, okay. Like you don't sleep, you don't lose sleep worrying about if he's coming back, right? Because you got the gold. So if the collateral is good enough and it's valuable enough, have at her. Take my 650 and come back with my 6%.
Okay,
right, or 6.5%. That's your base, right? So low LTV, first position, and it goes up from there. So
what makes it a 7?
What's that?
So what makes it a 7 then?
Okay, well, it's always a conspiring group of variables that conspire, but at its base, the LTV just went up, right? Say to 70. So you open up a little more equity. That borrower's asking for a little bit more. I'm going to ask you to borrow 700 instead of 650 against that $1,000 piece of gold. Okay, lower risk. We need to distinguish too between more and less risk and riskier, right? Like more.
What's the difference?
70% loan to value, you cannot argue, doesn't have more risk than 65%. Like right? Like I'm borrowing more, so there's more risk. Is it riskier though? I mean, you're talking about like, I'm happy in either one. I just get paid more in the 70%.
Yeah, I don't get much warmer, fuzzier feelings at 65.
I don't lose any more sleep at 70.
Right.
Okay. Even 75. Very comfortable. But in first position, we're starting to get to that like more emphasis on where's the property, what's the market for the property, how's the market doing, at 65, 70%, if I asked you, are you worried about the guy defaulting? Like you did your due diligence, right? Because you know our system, collateral first, ability to pay, exit strategy. Simple. So first question, at 65%, are we comfortable we could sell this house in a reasonable period of time, get all our money back? Yes. Now, you will do the due diligence, at least if you're, if I'm teaching you or we're doing it for you, you're going to do the due diligence to say, okay, can this guy or this girl make the payments for 12 months? Are they reasonable based on what we know about their income, their employment, and so on? If the answer is yes, then you look at, well, what happens in 12 months? Are they able to pay us back the principal? And if the answer is there, yes, you're going to do the deal. Now, everything can change the second you lend the money, right? So persons in love, they get divorced. Persons gainfully employed, they get fired. They're, healthy, get sick. Like anything could happen. So if it all goes that way, right? If you got it all wrong, what you're asking yourself is, at 65%, am I comfortable the collateral can set me free, even if everything was wrong?
Yeah.
Yes.
And to circle back, this is also to address the other comment we had where we're assuming that enforcement, we can enforce our legal right to liquidate the property.
You have to go through a process
because like we're assuming the agreements have been structured correctly, and there's not going to be anything like held up with lawyers and all that kind of stuff, which is a risk also.
But even if there's a risk there, it's time. At 65%, you're not worried about not getting your money back. It's just a matter of time and going through the process. At 70%, you could agree you have a little more concern, but you're still very comfortable. In first position at 75%, you're starting to evaluate closer the numbers. And at 80%, again, a little bit more. But listen, there's a reason why banks lend 80% to people uninsured. They've spent a whole lot more money and time trying, like,
It's been
I-
time proven, tested. It works.
more than I have. You know what I mean? I'm just copying them.
Yeah.
Right?
Yeah.
So now the scale, the beautiful thing about private mortgages is as you go up that scale, and we just walked through it, like first mortgage 65, 70, 75, 80, you still, in all of them, you still feel very comfortable. You're not losing sleep per se.
So at 8%, we're at 80 and maybe less desirable collateral, or what makes it 8?
At 80% right now, our highest rate, our highest rate is 9.5.
Okay, but an 8% mortgage, like what are we looking at with an 8%? Because we've done 6, 7, now we're at 8. So what makes an 8?
Yeah. So you're talking about, again, I mean, I just told you, right? It's just going up the scale a little bit. So 70 to 75, maybe it's 72, 71, right? And a strong borrower, strong credit profile. So as you go up the scale, because I know you want me to sort of like outline like this, it's not like that. It's not linear. There's too many compounding variables to make it linear. So there is an experience factor required here in some sense. There is a gut feel, but you're looking at the
Okay, then just approach
combination.
it from like a high level view then. Like,
You're not going to go, oh, 65%, 6.5, 70%, 7. It doesn't work that way because remember, there's three principles there.
mhm.
What is the ability to pay? What is the exit strategy? Are they both strong? If they're both strong and the collateral's strong and you're 65%, yeah, 6.5. And let me tell you something else. If you're not at 6.5 or 7, borrowers don't care. They're not loyal to any one lender. So if you really want to get your money out and have it in the hands of quality borrowers, you can't just charge the highest rates possible. You need to compete because the only reason that somebody would take 8%, a borrower would accept 8% if they're at 65%, good credit, good job, good situation, all the rest of it. The only reason they would accept 8 is if they couldn't find 6.5.
Yeah.
So as a lender, you're running the risk of like, I'm going to price this a little bit higher, and you're gambling that the borrower doesn't have another option. If they find another lender who looks at this and goes, 8, I'll happily take 6.5 at this. Remember, $100,000, 1.5 points, only $1,500.
We've had this in investor emails. This is we've underwrote this at 8, but we've been able to secure,
9.
yeah, extra point.
Yeah. So this scale of 6, 7, 8, 9, 10, 11, 12, break it into 2. 6 to 9, 9.5 is your first mortgage scale. 9 to 11 is your second mortgages. And in really good interest rate climates, you might see a second mortgage at 8 or 8.5, a really good one, 65, 70%. But let's be honest, how many second mortgages are there out there at 65%? Not many. It's usually the first that goes to 65, and then there's a second behind it. So you're seeing a lot more seconds at 70, 72, 74, 76, 78, 80, right? So the pricing scale is when I hear people say, it's priced according to risk, it's hard to identify risk in any one of these. Every private mortgage has some wrinkle. That's why they didn't get approved at a bank. So it's more so structure that really matters and making sure that you are priced competitive, looking for, I mean, if you're me, you're looking for the best marriage between security and return. Again, if you subscribe to what I'm saying, where I'm saying, look, understand the dollar value of 1%. For every $100,000 that you invest, it's only $1,000 a year. So, and here's the other piece. If you do any planning at all before you decide to invest in a private mortgage, and you look at it and go, I have $1 million to invest, and I own my house, I own my car, I'm retired, and I have to make $5,000 a month. I'm good. Well, that's 60 grand a year. That's 6% on $1 million. If all you need is 6, why would you take 9% risk or 10% risk? Even if it's 10% in pretty good second mortgages that are probably not going to default, but you don't need, it's one of the principles I teach is, help investors get what they need, not necessarily what they want. And it's healthier to invest that way because you have defined goals. You're not just shooting for the best you can get. So it's important to understand that, right? I feel like there's a big philosophical piece to this, right? We can live in private mortgages on residential properties in Ontario. We've proven you can live between 6 and 11 very comfortably. And we do have some investors that have been doing it so long, they're like, I'm good with the 11s. I'm fine with the 10s. And you know what? If there's a in 10s and 11s, I'll take a 9, no problem. But they like to be up in that 9, 10, 11. We also have, people who are just thrilled to be in 65% first mortgages, making 6.5 or 7. Thrilled because it's what they need. They're getting, and they never lose sleep, and they're snowbirds and they're flying all over. You know what I mean?
Yeah. So that's like the super solid one. So seconds start at 9%, you said.
Yeah, around 9. I
One,
mean, listen, would we make an exception on a really awesome second mortgage down to 8.5? Probably. There'd be an investor that would take that.
yeah. So once you get to 10, uh, should you be restless? Like, well, how do you feel when you're giving $100,000 to someone and receiving 10? How does that feel like?
Well, I mean, if you're getting 10 or 11, let's lump 11 in there. You're probably between 75 and 80% loan to value, second mortgage. And so it's not necessarily that there's a tremendous amount of additional risk. It's more so you need to do further due diligence to ensure you need to put more focus on the exit plan,
Yeah.
right?
It's, yeah.
What's the exit plan? Because at 80% loan to value, you are more susceptible to valuation risk, right? So the fluctuation in the value of a property. And we've talked about this in other episodes where, that shouldn't be something that scares you. It should be something that you prepare for. So, like, even if you had to take the property over and you found yourself in a market where it was tight and you weren't sure if you wanted to sell it now and risk taking a loss, you just hold it, repurpose it. You could rent it. You can, renovate it if you need to, any of those types of things. So at 10 or 11 in our portfolio anyways, those are still, very comfortable mortgages. Like, for example, here's what you're not going to find. You're not going to find us lending 80% of the value to someone who doesn't have an established career, like a job with job security. And you're not going to find us lending to somebody or I shouldn't say just job security, income security. Okay.
Right.
So, but you're also not going to find us lending 80% to someone that's shown a track record of consistent problems with managing credit. So someone who's in that 500s, low 600s score with a repeatable pattern, right, in their bureau of just having difficulty keeping up and managing. Because when that happens, we're looking at it and we're going, well, what are we doing here? Are we just kicking the ball down the street? Or are we bringing value to the borrower in that by accessing this equity, they can reverse course, fix whatever problem they have that's holding them back from getting to a bank and get back to the bank within 12, months.
Yeah. What are we doing? Are we keeping this temporary, or is this just like a wish that's going to extend longer than it was supposed to
Yeah, so
to play out for?
you're evaluating different things
Mhm.
at a 10 or 11, and you're safeguarding yourself in different ways. And if you're um, you know, I guess you're exploring more of what you would do if something happened, right? Something went
Yeah.
wrong. You'd be exploring that a little bit more.
So if I understand correctly, the main takeaway is that at the low end, you don't have to worry as much, or if at all, about how you'll be getting your money back.
You don't have
Whereas
to worry so much about the borrower.
the borrower, and the higher you climb, the more you should be concerned and monitoring and planning for an event where, okay, what if this goes into
Yeah.
a default situation and I can't get out?
If I was going to sum it up, I would say at the lower end of the yield spectrum, you are less concerned about the borrower, really heavily invested on the collateral. As we go up the yield spectrum, the borrower becomes more important. You want to make sure the borrower is going to be an asset to the equation.
Yeah.
At the lower end of the spectrum, if the borrower becomes a problem, it's less of a problem for you
Okay.
potentially.
And to reiterate what we've mentioned in, I think it was 1 or 2 episodes ago, what again is the percentage of deals that get to enforcement or
Oh,
possession?
so low. I mean, I don't think we've been long enough to give like a specific answer to that, but it's 1-2%. Like it's so
Yeah.
low. Yeah, it's just very, very low.
Okay.
Yeah.
Okay.
So,
Yeah.
I mean,
So
the bottom line here is you can live very comfortably, in my opinion, in the 6 to 11 range, if you follow, a series of pretty standard principles and you use common sense. And I guess the other real takeaway I want people to get from this topic is understand the value of 1%. Understand the value of 1% and do your math, right? And when you're investing in anything, whether it's this or something else, know what you need to get, because if that number's low, why would you take any more risk than is necessary?
because you know how humans are. Like when I'm retired, if I can get an extra 10K, I'm taking it.
Yeah, sure. Sure. But I mean, this is where the beauty of private mortgages comes in.
Well, I'm
Because
saying that now.
you
I'm
come
saying
to
that
me and
now.
say,
If I'm 65, I might think differently. I might be like, yeah, no, 60 is good.
well, time's a factor, right? Because the one thing you don't have at 65 that you have at 45 is as much time.
Correct.
So, you the beauty of private mortgages, in my opinion, is that if you came to me and you said so, and I asked you the question, what do you need to make? And we went through the calculations. We're like, you only need to make 70 grand a year, and I can do that at 7%. And you're like, yeah, but I kind of want to make 9. I'd be like, okay, well, we can still make that work. Like eyes wide open, right? That you only need 7. You want to make 9. The nice thing about private mortgages is you can be anywhere in this spectrum, and I think you can do very well. For part about getting 11 consistent all the time is the time factor. So it's like they don't like strong. Remember, we decline a lot more at the higher end of the spectrum, right? Because the risk is higher. So to come to me and say, I want 11s and only 11s, I think there's going to be gaps where it takes you 30 days, 40 days to find a quality 11. I mean, if you just want to put your money out at 11, you can find somebody to lend it to any day of the week. But if you do it the right way, if you do it, with a system, and you still want to be as safe as possible, it may take some time. You're going to decline, 3 or 4 or 5 before you find one you feel good about at 11.
I can see myself telling you, hey, I'm cool with averaging 9, spread it out over, let's say I got 5, 6, 7 deals in rotation. I'm cool with like spreading it out, and if one of them takes a little bit longer to exit, I'm cool with that too. So
Yeah.
as long as expectations are set, like I'm happy.
Listen, most of the deals that you're going to see are going to be 8s, 9s, 7s, 8s, 9s, and 10s, not 6s and 11s.
Yep.
So over a 5-year period, if you take, a 6 here, an 8 there, a 9 there, an 8 there, a 7 there, an 8 there, and 10, mix in an 11, you're coming out of somewhere in the 9 range, right? But you're optimizing your returns. Anyways,
That's
we
that.
good?
Yes.
Okay. Well, until next time, happy lending.